Anand Rathi Wealth. They came out with their Q2 numbers yesterday. And again, the numbers have been extremely stable. That kind of performance continues. So let's quickly switch over. Let's bring on board the management, Feroze Azeez, who's the Deputy CEO of Anand Rathi, talking to us about company's first quarter earnings, of course. And along with it, Feroze, you always provide us with nuggets with regard to how you're looking at themes and investing. So all of that should be a good chat. Let me first start off, Feroze, with your AUM, 57% growth. What in the AUM construct has grown best for you? Just talk to us about what's doing well.
I think, like you rightly pointed out, the AUM growth has been reasonably promising. 57% is good growth. Having said which, the more important barometer of how the business and my colleagues and all of us are doing together is the net flow. That has been 5,700 crores for the first 6 months, which is close to 1,000 crores a month in 6 months, close to 6,000 crores. I'm just rounding it off for better arithmetic or easy arithmetic. That's point one. Point two, 55% of our assets are in equity mutual fund, which implies that we have only collected intergenerational monies. We don't like to deal with clients who have temporary monies. So if they are intergenerational wealth, then since we are using the lowest risk equity participation security, which is mutual fund, 55% in equity mutual fund gives a fillip to the investor to at least get double-digit returns to beat inflation. That's point two. Point three, that was 50% a year back, and now it's 55%. So that implies that we have participated in the equity rally reasonably well without being circumspect of where the market is going, which is what the industry has done, right? We have tried to make sure that we look at earnings, we look at what kind of liquidity is there, what kind of broader market rallies are possible, what kind of domestic flows, and that's where our bullishness on equity is not today, but has been post-COVID, August 2020 is when we turned bullish. And that's what our clients are reaping benefit of. And the assets are 55% in equity, mutual funds, clean equity mutual funds. And then we have 1/4 of it in structured products, and then some portion of debt. And another portion, which is called others, which is raw material, which we bring on board to align to the three product classes, which we believe in for efficiency.
Right, Feroze. Now, when I'm looking at AUM, let me try and break this up a little better. You've got 47,000 crore is what your AUM was same time last year. You're currently sitting at roughly 75,000 crore in AUM. 28,000 crore increase over the last year. Talk us through fresh flows. You've spoken about last 6 months fresh flows roughly being 1,000 crore a month. Talk to us about fresh flows versus what you've done for clients in terms of growing their money. Just break that 28,000 crore for us.
6,000 crores is for this first half year. Okay, I think it would be 5,000, 5,000, 4,500, 5,000 for the previous 6 months. So 47,000 to almost 58, 57, 59,000 has come because of actually extra monies collected. And of course, the last 6 months have been upbeat, but I think like you saw, that there is a 128% jump in our collections between the first half year of this year and the first half year of the previous year. To answer your pointed question, 47 to 75 will have 10, 11,000 crores of collected money, and the rest of it would be mark to market, which implies that almost out of 28,000 crores, like you rightly did the arithmetic, close to about 40% is collected money. The rest of it is profits of our clients. So if you look at the profits being 15, 16,000, that will give you a color of how satisfied clients will be. Because most of my competitors have told people to preserve money and have 50% of their money in debt, which does not even beat inflation. For a person who is rich, he does not need money for his child's education. So he can have equity proportions which are larger as long as it can withstand the higher volatility in the interim, which I think that's the purpose of my existence, to handhold a person in the short term so that he can relish a double-digit return in the long term.
A little bit more on this, Feroze. Am I hearing it right? Debt is not something you focused on, especially over the last year or so, not added money there. And despite rate cuts being on the anvil, you're still not constructive?
If I filter my assets, see, we don't like to take assets which are short term. There are so many times when a client from his company gives us short term monies, we ask him to redeem it. We force him, sir, ye paisa le jao wapas. because it's distracting me. This is not private wealth intergenerational. Now, coming to your point of what's the opinion on debt, I personally think this opinion of rate cut is overdone, because if you cut the clutter and go a little more deeper, today the 10-year paper of Government of India is 6.89. Okay, 3-month paper is 6.56. The difference between this is 0.33. Okay, India's got never had such a flat end of the yield curve. RBI will reduce the short end of the yield curve, but the long end has not gone up. So why should it come down? Right? The gap between the 3-month paper and the 10-year paper for the last 10 years is 2%, 1.75% to be precise. So we have had the flattest yield curve. Even if RBI reduces interest rates, bond funds will not make money because they didn't lose money when RBI increased interest rates. And that's why I personally think this whole capital gain story in debt is not right, because if you don't lose money, you don't make money in bonds. And I don't think we are sitting at a 2%. If there was a 2% difference, if the short end was at 6.5 and long end was at 8.5, that is normal. So if RBI reduced rates, this 8.5 would have come to 7. 8.5 is already not the case. It's 6.89 as of today. So I personally believe that people are extrapolating a very common hypothesis that RBI will reduce rate, bond funds will make money. That's a wrong hypothesis, because RBI increased interest rates, bond funds didn't lose money.
Fascinating. And you've done, and I'll shift focus, as much as I'm tempted to venture in this conversation, I'll shift focus back to your numbers. You've consistently done 30% top line, bottom line, both. What gets you to do that? Is it just buoyant markets? What gets that consistency?
Of course, market has been buoyant, and your prayers have been there. So we have done well. But let me tell you that 20 to 25% is our guidance. And we very firmly believe this is possible consistently, if not quarter on quarter. We will try quarter on quarter, but year on year, 25% growth, 20 to 25% growth for the next 10 years, in my opinion, is sacrosanct. Of course, I'm telling you to my best ability of today's knowledge. I would attach a 90% plus probability to this event, knowing the business, whatever I know of. Point one. Point two, if you look at this whole perception that financial services business is going to be doing well only when there's a tailwind, that's what we want to prove otherwise. And that's been our professional aspiration, to create a market-agnostic financial services business, which is tough to create, but we are trying to. Now, let's assume if you look at this journey of 3 years of being listed, we have done 12 quarterly results. The worst quarter from a market standpoint was minus 9.6%, which was the FY23 first quarter, which was June 22, when US interest rates went through the roof. Nifty fell minus 9.6. The growth year on year for us that quarter was 33.6. The second worst quarter was minus 4% of Nifty, which it was FY23 again, but quarter 4. There also we grew 26% on private wealth and 23.6% on consolidated basis. So these were the 2 worst quarters of our listed existence. If you see the growth in those 2 quarters, that gives us more happiness than in a good quarter growing 32, 35%. So our professional aspiration is to build a market agnostic. And how is that possible? Like, which was your question. Sorry for the longish kind of an answer. There are 4 engines of growth. One is God's gift, which is doing well for clients, can increase the revenue because the growth of that 17,000 crores. If I make profits for my clients, my revenues grow. That's one leg of growth. The second is I have 30 clients per RM. So we have 374 RMs. That means I can handle 7,000 more clients without hiring a new RM. That's the second leg of growth. That is called capacity utilization. The third leg of growth is my existing 10,900 clients have almost 1 lakh crore outside. Once I do what I'm speaking, they start giving us money from outside. That's called penetration growth. That's the third cylinder of our growth. The fourth cylinder of growth is I have 400 odd people whom are apprentices, who are being trained for 2-3 years to get promoted as new RMs. That's the fourth leg of growth. With these 4 mutually exclusive legs of growth, we believe and we pray to the Lord that our effort is good enough to grow at 20-25% for long periods of time, because 10-12% is implied growth in this business.
Okay, Feroze, devil's advocate. Two risks that I believe could likely play out. Tell us if there are more. First is finding clients who can deploy that multi-generational kind of wealth to you. And second is people attrition. How large are these risks? Just give us perspective.
I love devil's advocate arguments because that's where we improve from. So I'm very happy because that's where sometimes your risks occur to you. So you have a very, very valid question. One risk, of course, like you said, will I have clients expanding? In our opinion, there are about 9 lakh families who have greater than $1 million of total investable surplus other than the home they live in. And that I think is an underestimate because India is a little unstructured market. So about 1 million people are there and I'm still 1% of the total audience. That's point one. So 99% of HNIs don't deal with me and they deal with somebody. So there is a lot of consolidation possible. Every one of these 10,990 clients whom I have at least 15 of my prospective clients on their phone book. Okay, and if I have almost 1.5 lakh people, I know via my 10,900 clients, I have to do justice to this 10,900 and do efficient finance for them to refer their friends without me asking for it. That's the pull strategy we are working on, and that seems to be happening. That's why you see an exponential growth in the number of client families. And quite a few of our clients today say, can you please come to present to 10 of my clients, 10 of my friends. They call us on their birthdays and say, these are my friends. I want to give them a gift by giving your service to them. This was the latest. So that's where our client acquisition will happen from. And if we do well, we will get clients eternally. Of course, we will have several challenges. We will navigate those challenges. We have had challenges in the past as well. So we will navigate that. The second risk we see is people's attrition. Okay, see, in the people's business, your plant and machinery, I am the plant and machinery, my colleagues are the plant and machinery, we are people. If you see, this ideally has not happened in the financial services industry, that it's been 15 months. We have not lost one RM in regret attrition. Any RM greater than 40 crores, if he leaves us or she leaves us, we call it regret attrition. And it is 5 consecutive quarters, that's zero. Okay, and this zero is a message. Most people who have joined hands with us are not monetarily motivated alone. So if there's a guy who earns 50 lakhs, if he gets a 1 crore offer, he still doesn't blink an eyelid. He says, money can't buy me. That's why you see 15 months of zero attrition, and we pray to the Lord that it remains that way. But we take pride in near zero or zero attritions for 15 consecutive months.
So let me look at it over 10 years, Feroze. Very impressive. At 25% growth from the 75,000 crore in terms of your current AUM, you'll roughly be at 6 lakh crore or maybe 6.5 lakh crore in the next 8 odd years, right? Not taking the 10-year period, 8.5 odd years. And you're yielding at 1.1 to 1.2%. Is that how one should look at it?
I think you should be a research analyst more. I think that's precisely how I would, in a simplistic fashion, look at my business. Of course, there are risks which will unfold. There has to be capability in the professionals and the grit to be able to solve those with a positive bent of mind. And we've seen several of those risks coming, and we've tried to navigate when the wolves are knocking on the door. Having said which, like you rightly said, 26% in 10 years means 10 times in 10 years. Now, if for arithmetic sake, so 25% would mean 6 lakh crores and 1.1, 1.2. We are possessive about two numbers, 40% PBT and 30% PAT. Anything more than that, we don't like economies of scale bringing us operating leverage. We like to reinvest in the business. So if I am getting to a 45% kind of a PBT, I would like to strengthen several departments which require strengthening to be able to be poised to handle a 6 lakh crore AUM. So that's why you would see 145 research people in spite of selling only 3 kinds of products, right? So to answer your pointed question, you're absolutely right. AUM results in an yield of 1.1, 1.2. Yield results in revenue. Revenue results in 40% PBT. 40% PBT results in 30% PAT. And this is how one should look at and multiply it with whatever P's the market is kind to give us.
The market, Feroze, currently gives you a PE of around 64 times. Therefore, if this growth were to continue, will look seriously impressive. Thank you so much for that conversation. Always a pleasure to chat with you.